BSC, MCX, Laurus Labs, Acuitas Chemicals have two things in common. First, they have made massive wealth for their investors, and second, the reason why they have made massive wealth is also common. And the very few who understand it have quietly made their biggest returns in the market, and that is called operating leverage. See, if a company's revenue grows by 20% and its profits explode by 60%, that is not magic. That is operating leverage in action. And that is the exact reason why some stocks give 10x returns and others struggle to beat fixed deposit returns. So, if you are serious about investing your hard earned money, then you cannot afford to miss this, because in this video, we are going to decode 4 types of operating leverage, look at real life examples of how it creates wealth. And most importantly, we are going to look at stocks in this video which are showing increasing operating margins. So let's dive in. So to understand operating leverage, you just need to understand these two words. First is fixed costs and second is variable costs. See, every business has a fixed cost. Setting up a hospital, building a tech platform, paying salaries, or just laying down fiber optic cables. See, these costs do not change much whether you have 100 customers or 10,000 customers. And once a business earns enough to cover these fixed costs, then something beautiful happens. Every extra rupee of revenue starts flowing almost entirely into the profit pool. Margins start expanding, profit grows much faster than the revenue. But how do companies actually trigger this? See, there are 4 main drivers for it. Now, the first and the most explosive driver is the scale, and the best example for it is platform businesses. Just look at Bombay Stock Exchange, BSE, and MCX. In 2020, BSE's operating margin was around 21%, and today it sits near 64%. And because of this crazy margin expansion, while their revenue jumped 8 times, their operating profit exploded by 25 times. And MCX story is even wilder. Their operating margin jumped from just 40% average to a massive 71% recently. Revenue went up 5 times, but profit went up 8 times. But why did this happen? Because building a high-tech trading platform is a massive fixed cost. Once it is built, whether the market trades at 1000 crores or 10,000 crores a day, the exchange does not need to buy 10 times more servers. The incremental cost is nearly zero. And that is why the market gives premium valuation to platform businesses. Once the scale kicks in, earnings growth becomes exclusive. Even loss-making startups show this. Just look at Ather Energy. A few years ago, their margins were a negative 523%. But as the scooter volumes grew, their massive fixed cost of R&D and factories got absorbed. Losses narrowed, margins improved, and the market rewarded them with a 3x stock price jump. So, stocks like BSC and Ather can be bought during the dip, but such increasing operating margin stocks tend to rally a lot, and many of the investors buy them at the peak. But to avoid this mistake, at RangaOne Finance, we provide a proper buy zone. Recent example is of BSC. Now we bought the stock near 2,800 and currently we are sitting on 41% profits. Plus, the team tracks all of these stocks. Whenever the stock comes near their buy zone, you get a notification. When we achieve the target, again you get a notification. You also get live market updates of all of these stocks. So if you also want to buy stocks at the right time, then join RangaOne Finance. Link is in the description. Now let's go to the second driver, which is premiumization. This is where a company stops chasing massive volume and starts shifting customers to high value and premium products. Take TVS Motors and Mahindra for example. Years ago, TVS relied heavily on basic commuter bikes, but they successfully pivoted to the premium Apache series and EVs. And premium bikes carry much fatter margins. So, over the last 5 years, while their revenue grew 2.5 times, their net profit jumped 4 times. And you see this everywhere. Even Radico Khaitan shifted from mass market liquor to premium brands like Rampur and Jaisalmer. Their revenue doubled, but their profits tripled. Even Apollo hospitals shifted to high-end robotic surgeries and oncology. The fixed infrastructure cost stayed the same, but the revenue per bed shot up. And then you have the ultimate combo of scale and premiumization. Now Bharti Airtel spent billions laying down fiber and 5G networks. Now that is scale, but the real transformation came from consciously pushing their average revenue per user higher through premium plans and Airtel Black bundles. Now the network cost does not rise when your tariff increases, so that extra revenue goes straight into the profits. Now the third driver is operating cost normalization. This happens when a company finishes a heavy investment phase. For example, Lotus Labs invested aggressively in R&D and manufacturing capacity. Now during that phase, the fixed costs were high and the profits were pressured. But once those capacities started getting utilized, the margin jumped from 15% to 26% in just 2 years. Revenue grew by 36%, but the operating profit jumped 2.3 times. Now, the fourth driver is operational efficiency, which simply means running the business better. See, for years, PSU banks have struggled with bad loans and high cost, but recently they have cleaned up their balance sheet and digitized their operations. Just look at SBI. In the last 6 years, the revenue has doubled, but the net profit has jumped 4 times. And Bank of Baroda, revenue doubled, but net profit jumped a staggering 20 times. So the leakage which was there in the system is fixed now. Now listen to me very carefully. This is where most retail investors lose their money. Now operating leverage sounds like magic, but there are two types. First is structural and second is cyclical. And if you confuse these two, then you will end up buying at the exact worst time. See, everything we just talked about, Airtel, Apollo, Acuitas, BSC, that is structural. The margin expansion comes from a better business model, scale, or premiumization. These are long-term compounding stories. But you also have cyclical operating leverage. This happens in commoditized businesses when there is a temporary supply-demand mismatch. And to understand this better, let us look at the metal sector. Let's look at Tata Steel. Between 2020 and 2022, their margins expanded from 12% to 26% and the profits exploded. Retail investors rushed in, but metal is a commodity. Soon after the cycle turned, margins crashed back to 10% and the profits tanked. And this is called operational deleverage. We saw this happen with the basic chemical companies in 2022 and also with the sugar companies during the ethanol boom. And right now we are seeing it with the optical fiber companies like HFCL due to temporary high demand. So if you want to play the upcycle in commodity stocks, you need to enter early. You need to know exactly when to exit. And trust me, trying to time a commodity cycle is incredibly difficult. Most of the investors enter at the peak when the news is the best and end up carrying the load. So how do we build wealth? First, never buy quality stocks at their peak. These stocks will give you an opportunity to buy them during the dips. Second, whenever you're allocating funds to stocks where the margins are improving, always check two things. First, is the margin improvement temporary or is it a structural change? See, for this, listening to con calls is very important because the management gives guidance about capex, growth, future outlook, and margins as well. For example, in Premier Energies, we are seeing a structural margin improvement. Their margins have improved from 5% to around 30%. Now, at RangaOne Finance, we had read their con call transcript. Therefore, we took a short-term trade. Now, currently, we are sitting on 30% profits as we have achieved our first target. But now we are aiming for a higher target of around 60%. Now, another sector where we can see strong margin improvement is the hospitals. The healthcare sector has done a heavy capex in the last 2 to 3 years. And now that capex can start converting into revenue and better margins. So keep an eye on hospital stocks like Max Healthcare, Narayan Hrudayalaya, Global Health and Yatharth Hospitals. And for disclaimer purposes, we are currently holding some of these stocks with our clients at RangaOne Finance. Now these stocks have good upside potential, but make sure you buy them at the right levels. As always, this was Sanika from RangaOne Finance, and don't forget to hype, like and share this video with your friends. And I will see you very soon in the next video. Till then, bye bye.